Banking conditions in the Ninth Federal Reserve District improved slightly in the second quarter of 2013, although the performance across states varied. My name is Ron Feldman. I'm the Executive Vice President at the Federal Reserve Bank of Minneapolis, and I'm going to talk about banking conditions for the banks that are headquartered in the Ninth Federal Reserve District. Just as a reminder, the Ninth Federal Reserve District consists of the states of Montana, North and South Dakota, Minnesota, the Upper Peninsula of Michigan, and the western portion of Wisconsin. So there are three main points I'm going to make today. First, in terms of the second quarter, there was a small improvement, particularly in profits and loan growth. In contrast, there was very strong improvement in the ratings that supervisors of banks gave those institutions. And then finally, in terms of the states, there was varied performance. The strongest states in the district in terms of banking conditions, which are North and South Dakota, remain the strongest. So let me provide a little more detail on each of these points. First, in terms of the relatively small change and improvement in performance. Asset quality, or here we're talking about problem loans, was generally flat. So problem loans are loans that are not being repaid in full or on time, and here in this graph we're measuring them relative to the financial resources banks have to absorb those problem loans. It's not a big deal that this ratio is basically flat because the absolute level of problem loans in the districts is quite small by historical standards. Again, looking at the graph, you can see that the black line shows the 20-year norm, and you can see that the current ratio is below that, which means that problem loans are lower than what they are typically. There was some improvement in profitability, up from a decline last quarter. However, here you can see that we are below the black line, and in terms of profitability, that means that profitability is less than the 20-year norm. And then finally, there was only a small improvement in loan growth, again after a small decline last quarter. In contrast, when we look at this graph that shows supervisory ratings, you can see there was strong improvement. So what are supervisory ratings? So all commercial banks in the Ninth District and in the country are supervised either by the federal government by itself or the federal government in conjunction with the states. Each of those supervisory agencies give the bank a rating, and the rating reflects its overall safety and soundness. The rating goes between 1 and 5. 5 would be an institution that's in serious financial difficulty, and 1 would be an institution that's very strong. Ratings that are 1 and 2 are considered to be satisfactory, and 3s, 4s, and 5s are considered to be unsatisfactory. By the third quarter of 2010, we had the highest percentage of the banks in the district being in unsatisfactory condition. It was about 1/3 of all the banks. An unsatisfactory condition means that supervisors are going to pay closer attention to the institution, supervise it more frequently, and put restrictions on the ability of the institution to operate freely. In the last quarter, we went from roughly 22% of the institutions being in unsatisfactory condition to about 20%. So it dropped by 2 whole percentage points in just 1 quarter, and that's really quite a bit. So again, that reflects the fact that we had a big improvement in supervisory ratings. Now you might wonder, why are ratings seeming to lag the financial performance? The financial performance has been improving for the last couple of years, and we're starting to see relatively a stronger improvement in supervisory ratings right now. That's because supervisory ratings lag in 2 ways. First, they look at financial ratios, which might be falling a little bit slower than the actual improvement in the condition of the bank. And then second, we're also going to be looking at non-financial factors like improvements in policies and procedures. And again, those can lag the actual financial condition. And I'm expecting to see a continued improvement in supervisory ratings as we go forward. And then finally, I thought I would talk a little bit about the condition of institutions in the specific states in which they're located. And here we're looking at a graph of loan growth. And it makes the point that there's really varied experience across the district. So one point I would make is that some of the institutions that saw a decline in loan growth, if you categorize the institutions by state, saw an improvement this quarter. That would be states like Minnesota and Montana. We also see that the strongest states, South Dakota and North Dakota, they remain the strongest states, but they're taking different paths. South Dakota continues to see strong improvement in loan growth, and North Dakota is seeing a decline in its loan growth year over year, even though it remains at a very strong level. So conditions in the second quarter for the district as a whole saw a small improvement, not very much. We saw supervisory ratings improving, and I think they're going to continue to improve. And then the actual performance by state is going to vary considerably by each state across each ratio. Thank you.